As December comes to an end, global financial markets are not reacting to headlines. They are adjusting how money moves through the system before the year closes. On December 2nd, 2025, global markets showed mixed but generally stable performance. According to Reuters, equities moved selectively higher, government bond yields edged up, and investors remained cautious as they assessed inflation data, interest rate expectations, and year-end liquidity conditions. This type of market behavior often looks uneventful on the surface, but beneath it, the financial system is actively managing pressure. What matters here is not whether markets finished up or down on a single day, but how liquidity is being maintained at a critical point in the financial calendar. Just one day earlier, on December 31st, 2025, Reuters reported that banks made record use of the standing repo facility operated by the Federal Reserve. This facility allows financial institutions to exchange high-quality collateral, primarily U.S. Treasuries, for short-term cash. This did not occur during a financial crisis. It happened during a routine but sensitive moment: year-end balance sheet management. Every December, banks face tighter regulatory and accounting constraints. Liquidity becomes more valuable, not because the system is breaking, but because access to funding must be precise. Even small mismatches can ripple outward. The repo market is often described as the plumbing of the financial system. It is not visible to consumers, but it keeps money flowing between institutions that support credit, trade, and production. When usage of a central bank facility reaches record levels, the signal is not panic. The signal is structural dependence. Reuters emphasized that the standing repo facility is now a permanent tool. It was created to prevent short-term funding stress from turning into systemic disruption. Its growing use shows how modern markets function, even in periods considered normal. This marks a clear shift from previous decades. Before the 2008 financial crisis, central banks intervened primarily during emergencies. Liquidity support was exceptional. After 2008, and especially after 2020, liquidity infrastructure became continuous. Today, the system assumes that central banks will provide a backstop, not to stimulate growth, but to keep money circulating smoothly. That distinction matters. High interest rates alone do not determine financial conditions. What matters is whether liquidity continues to move. In late 2025, interest rates remain elevated compared to the previous decade. Inflation has moderated in many economies, but has not fully disappeared. Growth remains uneven across regions. In this environment, markets are not expanding aggressively, but they are also not contracting sharply. They are balancing. In Europe, investors are closely watching signals from the European Central Bank. Knowing that financing conditions directly affect credit availability for companies, governments, and households across the euro area, this balance explains why capital flows appear cautious rather than decisive. Companies continue to finance inventories. Supply chains continue to operate. Employment decisions are often delayed rather than reversed. These outcomes depend heavily on short-term funding stability. Without that stability, even profitable businesses reduce activity. The importance of liquidity infrastructure becomes clearer when looking beyond markets. Credit availability influences production schedules. Production schedules influence inventory levels. Inventory levels influence consumer prices. This chain does not start with consumers. It starts with financing. When banks are confident that short-term liquidity will be available, they maintain lending lines. When lending lines remain open, companies avoid sudden cutbacks. When cutbacks are avoided, price volatility tends to remain contained. This does not eliminate inflation or slowdowns. It reduces the probability of abrupt shocks. In the United Kingdom, this dynamic is visible in equity performance. In late December, the FTSE 100 approached historic levels, supported largely by energy, mining, and established companies with stable cash flows. Market coverage highlighted that these gains were driven by sectors tied to physical assets and real production rather than speculative growth. That composition matters. It shows that in the current environment, capital favors durability over leverage. Businesses that generate cash from tangible activities appear more resilient under tighter financing conditions. This is not a market trend. It is a system response. The global economy at the end of 2025 is not driven by optimism or fear. It is driven by risk management. Banks manage liquidity risk. Companies manage financing risk. Policymakers manage systemic risk. Central bank facilities sit at the center of this network. The standing repo facility, for example, does not inject new money into the economy in the way quantitative easing once did. It simply ensures that existing money continues to circulate without interruption. This distinction is crucial. Liquidity support today is about stability, not stimulus. That stability is what allows the system to absorb uncertainty without breaking. For consumers, these mechanisms remain invisible, but their effects are not. Stable funding conditions help prevent sudden spikes in borrowing costs. They reduce the likelihood of abrupt layoffs driven by financing stress rather than demand. They help smooth supply chains that would otherwise pass disruptions directly into prices. As this video is published on December 3rd, the year is entering its final month. Financial institutions are closing books. Companies are finalizing inventories. Governments are assessing fiscal positions. The system is tightening, but it is not freezing. That is the signal. The global financial system is increasingly dependent on continuous liquidity infrastructure to function smoothly, even outside crisis periods. This dependence is now structural. It shapes how money moves, how risk is absorbed, and how economic adjustments occur. This does not guarantee stability. It explains how stability is being maintained. Money signal does not focus on what comes next. It focuses on how the system works now. Because in modern economies, the most important signals are rarely dramatic. They are embedded in mechanisms, quietly operating in the background. Understanding those mechanisms is essential to understanding money, prices and production, and that is the signal at the end of 2025.